Is there anything more frustrating than this? You buy the breakout, it fails. You short the breakdown, it snaps right back. You're getting chopped up by the market that has zero follow through. Do you want to make money instead of getting bloodied in a ranging environment where the market has no sustaining momentum? Then this video is for you. I'm Mike Bellafiore, and we're one of the top proprietary trading firms in the US with numerous 7 and even 8-figure per year traders. We hope you agree you've found the right place to help grow your trading account.
Hi, I'm Seth Froberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And every equity trader on our trade desk will tell you they absolutely love those periods of time when the market is moving hard, like earnings season. Either way, up or down, they're happy. But at the same time, they hate another kind of market, the listless, directionless, range-bound, choppy market, where the market seems like it doesn't know what it wants, and those kinds of markets are hard to trade. Well, we have an answer for that. A strategy that works best, believe it or not, when the market is range-bound and directionless. And the best part is it's really easy to understand and just as easy to implement, and that's what we're going to be teaching you in this video. Now, before we get into the option strategy we'll be teaching you in the video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the strategy that we're going to be teaching you in today's video. Then you can come back after you're finished with that and watch the rest of this video. So to show you how this strategy works, let's head back to January 17th, 2025, the third Friday of January, which is a day in each month where there is going to be an options chain for each month for any major stock or index. And as you can see on that day, the index had actually been in one of those range-bound markets that we were just talking about, a choppy, directionless market meandering between 5850 and 6100 for over 2 months. And these kinds of markets can go on for a long time, actually. If you look back historically, you will see that that is the case. And so when experienced options traders see this kind of market developing, that's when they look for an opportunity to execute a trade that does best in a range-bound market naturally. And so let's say that on that day, we pulled up an options chain expiring on the third Friday of the next month, February 17th, 2025, 35 days later. And we went ahead and sold a call right at the top of that range at the 6100 strike price for $49.80. And we simultaneously sold a put at $58.50 right at the bottom of that range for $44.70. And then we moved over to the March 21st options chain, expiring exactly 1 month later. And we went ahead and bought a call at that same strike, at that top range, that 6100 strike, for a price of $88.95. And at the same time, we bought a put right again at the bottom of that range at $58.50, the same put strike, and that cost us $73.50. And so when we do that, selling a call at one strike and selling a put at a lower strike, and then buying both of those strikes on a later expiration options chain, when we do that, we're entering into what options traders refer to as a double calendar, which is the perfect strategy to use in a range-bound market situation. Now let's first be clear about the cash flow of this trade, so you're going to understand what it would take to make a trade like this. And so starting with those options we bought expiring in March, we paid a price of $88.95 for those, but remember, index call options pay off at $100 per point above the strike price on the day the option expires, so you multiply that by 100 to arrive at the actual cash flow from buying that call, which is $88.95. And using that same kind of calculation, we can see that we paid $70.50 for the $58.50 put. And by the same token, we sold the 6100 call expiring in February and received $49.80 in cash for that. And selling the $58.50 call expiring in February, that brought in $44.70, resulting in a net overall cost to us of $6,795. Okay, so at this point, you might be wondering, what's going on here? How does this make any sense at all? Why are we selling options at the same strike prices we're buying options on different expiration dates? What is this? Won't the calls we sold cancel out the calls we bought? And won't the puts we sold cancel out the puts we bought? How can this whole thing make us any money? Well, you're going to find out in a minute exactly how this works, and then you'll get why options traders love using double calendar trades to profit during range-bound markets. Okay, so let's move to the day this trade expired, which is February 21st, as you'll recall. And as you can see, the index continued to generally channel inside that range, closing at 6,013.13 on the day this trade expired. And so think about it now. If we look at the value of the call option that expired, well, that call option expired 86.87 points above where the index closed, down at 6,013.13. And so that option obviously expires with no value because the calls only pay off if the index closes above that call strike price. And similarly, the 58.50 put also expires worthless because the index closed more than 163 points above its strike price. And of course, puts only pay off if the index closes below their strike price on the day they expire, and so that's a zero value also. But don't forget about the options we bought, which are still alive and expire 28 days later in March. Let's take a look at their value. You see, those options have another 28 days to go, and so the option sellers have to continue to load value into those options because they're on the hook for any rally above 6,100 on the call side or any sell-off below 58.50 on the put side. They still have to have some value, although less than before because the market just doesn't have as much time to make a big move as it had a month earlier. And so naturally, the price will come down, which is what options traders call time decay. And so in this case, the long March call, which was originally priced at 88.95, has now dropped to 54.05. And the long puts, which were originally priced at 73.50, have now dropped to 44.20. And so when we add the current value of those two options to the zero value of the expiring options and then subtract out the cost of the double calendar spread in the first place, you could see that we produced a profit of $3,030, which is a return of more than 44% on the original risk capital of $67.95. And so now you can understand why we sold options in the earlier options chain and bought options in the later options chain, because we knew that if the market stayed inside that channel that it had been traveling in over the prior 2 months, then both of those shorts would expire worthless, meaning we get to keep all of the premium we collected selling those. Yet the long options we bought will always have some value on the day the short options expire because they still have some risk. So if the market stays in the channel, our short options are going to make their maximum profit. In other words, they'll expire at zero, while our long options still have plenty of value in them, which will almost always result in a solid profit, as we got in this case. And so now you see why we were selling options that expire sooner while buying options that expire later. The relative loss of value of the options that expire sooner will always be greater than the loss of value of the long options that expire later, and that's the reason that the calendar spread makes money. And so what I'd like you to take away from today's video is that the double calendar spread can work beautifully in channeling markets, especially if the short options are far enough from the center of the channel that there's a good shot that the market may just channel between the short call and the short put, and the trade can almost always be successful. Options professionals are well aware of these kinds of profit-making opportunities, and there's no reason that a retail trader like yourself shouldn't be able to harness those same strategies to your advantage.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.